key inflation gauge, the PCE price index, rising in line with expectations last Friday. Our next guest says that the market should temper expectations of 3 rate cuts this year and possibly even give small odds to the less likely but not impossible notion of no cut at all. I want to bring in Roger Ferguson, Fed Vice Chair and a CNBC contributor. Let's go straight to the idea of no cut at all. What do you think the true odds of no cut at all are, Roger? Because the market does not have that baked into their cake.
Well, look, right now I think the true odds are low, call it 10 to 15%, but not zero. And the reason is that inflation has, for a couple of months, remained a little higher than one might have hoped. I'd describe it as firmer. Chair Powell over the weekend, having seen the incoming data, was clear that the 3-cut dot plot is conditional on the data playing out as expected. And so I think right now it's really much a wait and see. Right. The Fed's in no rush to cut, and the data may be firmer, and they may not cut. We'll see.
Roger, I was struck by this idea that there is dissension on the board, and I don't know how typical that is. It appears now that the quarterly projections show that 10 policymakers anticipate 3/4 point rate cuts this year, which I think you now take issue with, but 9 committee members see 2 cuts or fewer. How often is that kind of dispersion the case?
Look, it's not totally surprising when you get to these points where, I think the desire would be for inflation to continue to come down. It has come down much more slowly. So, look, one should expect people to have slightly different views. Those are not diametrically opposed views. I thought the last time around that the dot plots would lean towards 2. I was basically off by 1 voter or 1 member. So I'd observe it and think it's what you'd expect. And it depends it shows how sort of muddled the data are right now, and it's not giving the clearest possible signal because we've had a couple of months where it's been slightly firmer than one would have hoped.
We're not that far from zero. I mean, when you get down to some people were saying 1. I don't even know what that does. But 1 or 2 is not that different than 0. Let me just ask you a question though. We must be. You think we are restrictive right now? Because if we're not restrictive right now, and if inflation continues to be a problem, and we're actually not restrictive, it could be a hike eventually, not just no cut. Couldn't it? Or you figure we definitely are restrictive, so this will work where we are right now?
Look, Joe, I think we are restrictive, but everyone is scratching their heads just a little bit with how firm the economy has been in the face of what we thought was restrictive policy. There's a little bit of a technical debate as to why not so-called neutral or the R star has moved up, i.e. it takes, we're not as restrictive as we thought. So it is fundamentally a big question right now. I think it's highly unlikely that we'll see an increase. As I said, put 10 to 15 odds on sort of no further cuts, and we stay where we are for a period of time. And so right now it's very much data dependent, and I'll have to say, the prior expectations of what it takes to be restrictive might be questioned just a little bit because the economy has been doing, very well, which is a good thing. And employment has been holding up. All of that is a good thing, but it may suggest that, I think we're in restrictive territory, not as restrictive as perhaps many, including myself, had been thinking.
But if that's the case and the market doesn't appreciate this, which way, do you expect there's going to be a come-to-Jesus moment for the market?
Andrew, we've been talking about this on and off. There have been, as we would observe, several come-to-Jesus moments with the market where they really are betting, market participants are betting on what I'd say almost hoping for the cut that would then validate, how equity markets and to some degree fixed income markets have been moving. So yes, I do think there's a possibility of another one of those disappointing moments when the market wakes up and realizes the Fed is not moving as quickly as they thought, not moving in the right direction from that standpoint. So yes, I think the possibility of more market turbulence is higher as the market and the Fed
I'm just curious, Roger, when you see
aligned.
what's happened to the stock market, even over the last couple of weeks, do you say to yourself, these people don't understand? Or do you say, actually, the economy is really strong and these earnings are really going to be strong and this makes a lot of sense to you?
Unfortunately, or maybe ironically, I think all of those things are true. The economy is strong. That is a good thing. Earnings have come in reasonably well. That's a good thing. insofar as they are expecting all that to lead to a Fed cut, that is the place where I think there's a little disconnect, or at least leading to 3 Fed cuts. So I think there's a disconnect that is existing, and that may mean that there will be some volatility, and maybe we will not see this continued movement up that we saw, in the first quarter of this year. So, perhaps a flatter market going forward with a bit more volatility as the Fed itself figures out what it's going to do, and as the market figures out with the Fed what is going to happen.
Look at Bitcoin prices this morning. We're just hovering under $70,000 right about now. This month expected to bring the next Bitcoin halving, in which the reward for mining cryptocurrencies drops by half. Joining us right now on All Things Crypto, Anthony Pompliano, Pomp Investment founder, of course, and partner. Good morning to you. We were trying to figure out, on one end, it's like a risk-on situation. On the other, it's arguably supposed to be a hedge, and it's very hard for me to get around the idea that it's both, though maybe you have a view that it is. Then there was the halving that's coming, so that's sort of an idiosyncratic one piece of the puzzle, but not something that's like an ongoing piece, so you could argue it is in certain ways. And then you have the ETF, which was also sort of an idiosyncratic moment in time. So put that puzzle together for us.
Yeah, Bitcoin is the most exciting asset in financial markets because of what you just described. It's this highly complex thing that everyone's trying to figure out. And I think for some people it is a risk-on asset, and for other people it is a hedge against inflation or a store of value. And so if we just look at
Can it be both?
Of course, it can be different things to different people. Right now, I think one of the most interesting parts about this is if you go and you talk to someone on Wall Street, why are they buying it? They're buying it because they want the price exposure via the ETFs. But if you go and you talk to someone maybe in a country where they actually are worried about somebody seizing their assets, they're buying Bitcoin because they literally want to make sure that they can hold on to the economic value. And so you have an asset that this is not unique just to Bitcoin in the sense of some assets serve different purposes for different people. I think Bitcoin, because of its global nature, because of the decentralization, and because it was adopted by individuals before the institutions, we're just seeing it kind of exaggerated as we watch the asset become adopted. Now, we just hit a really important milestone before the halving. We just had the highest weekly, monthly, and quarterly close for Bitcoin.
Right.
And so the last 4 times that that's happened, Bitcoin has appreciated at least 300% through the rest of the bull market. Right. Doesn't mean it's going to happen again, but to have that happen before the halving, it's kind of like the demand shock happened. Now we're going to have the supply shock. Right. And so it's hard just to see how the price doesn't continue to go up.
I want to ask you this question, and it goes to the risk on versus the inflation hedge. So I just got back from South Africa. Mm-hmm. And I literally asked anybody who was around when I was in Zimbabwe, in Zambia. By the way, the rand has done terribly. Of course. Right? It had been inflated away. Horrific situation. And I would ask anybody who was around, very wealthy people, folks who are middle class, folks who are at the bottom of this, and I said, do you own any Bitcoin?
Yeah.
Almost to a T, they said no. That actually was not a thing. And this was, and by the way, this was, I mean, it wasn't a scientific study, but a lot of people I asked about Bitcoin because I thought that the conversation we have around this table is that somehow the unbanked and everybody who's in these countries that is struggling with inflation is buying Bitcoin.
Yeah.
And they're, at least from what I saw, they're not. And then I went to look at the flows, and it also is true that they're not.
Yeah.
The math does not suggest that the hedge argument on inflation is actually a real one, and I just wonder whether it's sort of used to sort of sprinkle fairy dust to other people who then are speculating. I think there's a lot of people out there that are speculating and want it obviously to go higher, and it's a risk-on asset. That's my take on it at the moment.
Yeah, so I think it depends on what country you go look at, and I'll give you kind of 2 examples, one that supports yours and one that would contradict it. If you go to somewhere like Nigeria, it's definitely true that people are buying Bitcoin, and I don't know why it's happening in Nigeria, not in South Africa, but we see that. Then if you go somewhere like Argentina, there are some people buying Bitcoin, but there's a lot of people who want dollar-backed stable coins, and they actually want the dollar, not Bitcoin. And so I think country by country, you're going to see different adoption of these technologies. Now, what I will say, though, is you don't have to go to emerging markets to find a reason why people want to buy this, right? If you look at the United States dollar, it's lost 25% of its purchasing power since 2020. Bitcoin is up 800% during that same time period. And so if we go back to 2020, if you remember, Paul Tudor Jones, Stanley Druckenmiller, many of these people came out and said, look, I think it's an inflation hedge. Now, hedges are always this weird thing where people expect you buy it and then inflation explodes the next day. But instead what we've seen is that Bitcoin is a free market asset that trades forward looking. And so Bitcoin's rise, it's up. We have 7 straight months of Bitcoin in the green up till this past month. And so Why is it going up? Some of it is the ETFs. Well, inflation is coming down year over year, but it's actually, but inflation is actually going up month over month.
It's anticipating the next easing cycle. That's what it's anticipating.
So you could argue, one, it is anticipating the next easing cycle. You could also argue the alarm bell is going off, and actually inflation is not coming down month over month. It's going up, and people see that, and they're buying Bitcoin. And so Bitcoin going up is telling us, wait a second, inflation is a bigger problem than we actually thought.
During the hiking cycle, it went from 65,000 down to 17,000.
Correct.
You don't think the majority of people that are buying the ETF today or even buying underlying Bitcoin are doing it because they think the train is leaving the station and they want to be on the train? And that's what this is about.
Why would they have thought the train's leaving the station at 25,000?
Well, I think, unfortunately, what happens, as you know, is people like to get on the train once the train has practically left the station. That's how this is.
It went to 17,000. Why would people, when it's dropped from 65, when you were looking at it from 7,
right.
You know, and like, why would anyone buy this after?
I think there was a lot of people who were very nervous about it after FTX and the collapse.
That's what I mean. So why?
Right.
What do you mean they're getting on the train when the train is turned around and gone into the toilet?
No, I'm saying that I think that now they see the ETF, they see it moving back. They think, okay, now
25 to 40, I think, was speculation on the ETF was going to get approved. 40 to 70 is definitely the ETF flows are here. But I think, again, going back to where we started the conversation, is this is a highly complex environment where Bitcoin is serving different purposes to different people, and one that makes it attractive to a lot of folks.
But I guess what I'm saying is it may serve different purposes to different people. But if you told me that 90% of the people were in my mind, this is my own thesis. I think 80 to 90% of the folks who are buying this thing are buying it because it's a risk on, the train is leaving, or I think the train is leaving, and I want to get in on the action. And that there's another 10 or maybe 20%, maybe, who have this sort of inflation hedge idea that around their own exposure to their own currency.
Look,
but I don't think it's a 50-50 thing. I don't think it's a. You see what I'm saying?
Well, what you're calling out is just a societal trend, right? We have become a society of gamblers. If you think about it, we have zero-day options. Now we're more than 50% of options trading. We have sports betting, right? We have meme coins trading like 1980s boiler room, penny stocks. This is all happening. And so, again, why is that occurring? The dollar has lost 25% of its purchasing power in 4 years. We have $1.1 trillion of credit card debt. We have 43 million Americans that have federal student debt. The average balance is $37,000. People have lost hope. They do not have hope. How are you supposed to live in a country where it is cheaper to rent than buy a home in 50 major metros? You don't have hope. And so what do? You
think this is a lottery ticket? This is a gamble?
I think that if you go and you buy a lottery ticket, it's 300 million to 1 odds. I think there's people right now saying, you know what, a meme coin has better odds than a lottery ticket. I think there's a lot of people who say Bitcoin is actually the safest thing.
Joining us with an on-the-ground take on the new fast food minimum wage in California is Scott Roderick, a McDonald's franchisee in California. He owns and operates 18 restaurants in the northern part of the state. And Scott, why don't you just tell us what it's meant from your perspective?
Well, good morning, Becky. Thanks for having me. The day is now dawned upon us where countless operators in California face this $20 wage. It impacts 15,000 restaurants up and down the state of California. It's going to be the most serious challenge for entrepreneurs that do business on the franchising platform. The vast majority of these restaurants run by small business proprietors who do business on the franchising platform, and the vast majority being family owned and operated, just like my restaurants. You know, I want to underscore the words family owned because franchisees are not large global corporations. The restaurant brands that we franchise might be national in name, but franchisees are local business operators. It's an important fact that somehow it seems to get lost in the legislation that was crafted. And as you stated earlier regarding, it is absolutely the intent and consequences. And for many, what makes this legislation unprecedented, let alone extraordinary, is that it only benefits employees who work in franchise restaurants. Whether you own one single donut shop or 10 donut shops in California, if you're part of a franchise brand with 60 or more locations, the new wage mandate is going to apply to you. And as you just stated, this is an extraordinary wage jump, 25% overnight. It's a serious concern for two reasons. First, it targets only fast food restaurants. And second, the sheer scale of the impact is just breathtaking. Historically, as you said about step-laddered approach, many cities have studied and put forth living wages with annual CPI bumps. Certainly the city that I opened my first McDonald's in, San Francisco, is one great example of that. They chose a fair living wage. They set an annual CPI cap, and it allows us to plan for that as small business owners. It's fair to the employees, and it's fair to people who create the jobs.
We've already heard that some pizza delivery stores, for instance, have laid off or gotten rid of 1,000 jobs or more ahead of this, that they're just not going to do that anymore. They'll use the Uber and Lyft apps to go ahead and have deliveries done that way. Uber and Lyft don't have to abide by that because their employees are not employees, they're contractors. You look at these workarounds that kind of happen with this. What are you doing in preparation? Are you going to lay people off, or are you going to find other ways to make up and make good for that 25% increase in wages?
Well, obviously, my team is focusing on every possible action to survive and maybe even thrive in the tumult that's going to start today. Obviously, one of the most critical levers that I can use as a business owner is price, but I certainly can't charge $20 for a Happy Meal. So I have got to be aggressive in seeking labor efficiencies to drive the top line. I've got to accelerate the digital channels even more. I've got to promote more off-premise delivery. Families are going to have to make very hard choices around capital X expenditures, for example. Can I postpone updating a restaurant dining room? Can I put off investing in a new rooftop HVAC? And even the bigger question, should I open a new restaurant in California against these extraordinary legislative headwinds? The topic of the day seems to focus on the obvious move to cut labor or reduce staff size. But frankly, at least in my organization, that's the last thing I want to do. People in my company, and it's been this way for 30 years, are my greatest single asset. So the last thing I want to do is impact the folks that run my golden arches. But as you pointed out, even leading up to today, Pizza Hut and Round Table Pizza have laid off 1,500 drivers up and down the state. In an area that I do business in, Redding, California, at the end of January, 18 Subway sandwich shops, family-owned, closed overnight. This is just a harbinger of things that will come, and I am going to do everything I possibly can to not only protect and defend my equity, but to grow my business so that I have jobs to provide the community.
Joining us now on inflation, the market's strong performance in the first quarter, and much more. Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. Good morning.
Good morning.
He had Roger Ferguson on, and I think the general perspective right now is that inflation is still a little sticky, but no one expects it to really turn around and head higher or to stay like this for a long time. The idea that we could actually need to start another rate hiking cycle is not on anyone's mind. So if we are at this point where, yeah, we get some, we get a few bad data points, but we're trending in the right direction with these great earnings and with this great economy, why not stay long? But I would think the minute that it became clear that the Fed is not, if they aren't restrictive here and actually would need to raise, I think that could probably throw a wrench in the works.
I agree 100%. If we go back to the higher for longer kind of discussion, that would be an issue. For now, we're in a high for longer discussion, which means rates can stay at these elevated levels, but the next move is a rate cut. I think what was really damaging last year was the idea that we're not entirely sure how far the Fed is willing to take rates higher and hence damage the economy in its inflation fight. And I think the December FOMC meeting, which was emphasized again at the March meeting and in Powell's speech last week, is that really they're not willing to sacrifice the economy to get inflation to 2% in a shorter timeline. They're okay with bumps in the road. They're okay with inflation getting to 2% over a 2-year time horizon. And we don't have to fear. We can actually cheer resilient, strong economic data. And that's what I think is behind these all-time highs in the market. And most importantly, the broadening out in the performance where we've started to see cyclicals participate.
So you think high for longer?
I think that's much more manageable. And you can see that in corporate behavior as well. For companies, what was really damaging was not really knowing how high the cost of capital could go. Once you have a better feeling of around where it can be, you start to see more bond issuance, M&A, IPOs, and hence it really opens up capital markets, and that's a good thing.
Because we went from 6 cuts, and then we went maybe 4, and maybe now there's 3, and there are people talking about 1 cut that we heard, or now none, and the market hasn't moved at all. So somehow I was able to digest that and go up 100 points every day.
I think that's a good thing to see that the stock market is not held hostage by the daily moves in Fed pricing expectations or even the 2-year, the 10-year. That's a good thing because it means investors are going back to focusing on fundamentals, on earnings. And it also signals a focus again on resilient nominal growth and hence a broadening out in earnings growth as the year progresses from just that Mag 7 earnings growth, which was the story last year, to much more of a broadening out in the recovery of earnings as the year progresses, and hence more participation from different sectors.
There are things on the horizon, near-term and long-term geopolitical things. I don't know where you want to start. Like Taiwan. I mean, so many things. Ukraine, Taiwan, the Mideast. Yeah. We've got this huge amount of debt overhanging. Is there a productivity solution to some of our debt issues here or is that just so far off that we'll get whatever that expression is? Was it Thomas Aquinas or Thomas More? I'll get chased down, just not today. But I mean, we're fine now with $33 trillion in debt. Keep buying stock. I
think what we learned in the middle of last year is there is a focus on the elevated level of the deficit and hence on Treasury issuance when we had that freak out in the middle of last year as a result of elevated Treasury issuance. And I think that's one of the reasons for us that we don't expect long end yields, so think 10-year plus, to really deviate from this range that they've been in since the end of last year. Let's call it 375 to 425 until there's eventually a recession. That's incorporating a certain premium for all this Treasury issuance. Now, the risk later in the year, we think, is as we get closer to election season and we actually start hearing more from former President Trump and President Biden, as well as the general proposition for what to do with the individual tax cuts worth $2.6 trillion, which are set to expire at the end of next year. And then that could lead to even more of a focus on even higher deficits and more Treasury issuance.
Gabriela, I just go back to this issue of if inflation starts to get higher, are we really facing a Fed that's not going to do something about that? And then not just this Fed, what happens if there's a change in the administration and there's a new Fed chief who comes in 2026 or maybe sooner? It seems to me that all of these politicians are listening for the litmus test being, are you going to be easy on rates for the next Fed chief, whatever they look for? I think Powell's a different case. He kind of does what he wants. If you've got somebody else in there, is anyone going to be able to say, no, I'm going to do what needs to be done for the case for inflation? And maybe that's a different way of looking at things.
I think for us, we do think the Fed is independent in its mandate and is really focusing.
I think Jay Powell is too.
I think if you start politicizing central banks, that doesn't tend to end well. We've seen that time and time again in emerging markets, and we hope that doesn't become the case here. I think in terms of inflation, if we're where we are, which is just, as Chair Powell said, bumps in the road on the journey towards 2% over a certain multi-year time horizon, that's okay. I think the danger does become, Becky, if inflation expectations start to become unanchored again, either because inflation starts to come in higher or gasoline prices continue moving higher.
Wages continue to climb like they're doing. We're talking about
or real wages continue to move higher, but without the accompanying improvement on the productivity side. I think really the thing to watch is inflation expectations. And the good news is when we look at the Michigan Consumer Sentiment Survey is so far, actually, inflation expectations are moving lower. And I think that does give the Fed comfort to wait out the disinflationary process.
Do you think Jay Powell is going to be in this job? How long do you think he's going to be in this job? Do it that way. No, seriously.
Yeah, I think it will depend on the new administration and whether
he's... If the current administration is the administration in the future, he would get another jump?
I'm not sure. I think it certainly is not an easy job.
And don't you think it's politicized already? I mean, when Kevin Warsh comes in here, he has his own very different views about what to do, and they, at some level, underneath it all, are somewhat political. Having said that, you could say that Jay Powell was political insofar as he's now been on two political sides of it.
We would prefer less Fed speak, personally. I think it is a lot of daily commentary to digest, and we already have quite elevated volatility across the yield curve, but it is what it is. And we do tend to look through some of the day-to-day noise and just focus on Chair Powell, which has been very focused on building consensus in the committee. But let's see what happens with the new administration. I don't think we're at the point where you see in emerging markets, the president just tells the central bank what to do.
Peter Kraus, CEO and chairman of Aperture Investors. I don't want to put words in your mouth, Peter, but I think you think we're restrictive. I think you think that we are slowing a little. You're seeing it somewhere. As a result, we will see some cuts, and that's going to make small caps just take off. Do you need to even say anything now?
I do think that.
Can you fill in the blanks?
Fill in the blanks.
Convince me well, number one, convince me you're seeing pockets of weakness in the economy. Where are they? And why aren't they obvious to everyone?
Well, I think when it's obvious, you have a recession or you have significant decreases. But you can see earnings growth slowing, particularly in the small cap space. If you looked over the last 2 quarters, you saw retail stocks, consumer discretionary stocks having slower growth over that time period. And even the large cap stocks, what Andrew referred to, the Magnificent Seven, whose revenues continue to grow at faster rates than everybody else, we see that evidence that's actually there. And there are some stocks that have actually reported that, small cap stocks have reported that in the next few quarters, they think their revenues are going to accelerate. And so, there's a feeling in that sense that executives think they're at the trough. And if, in fact, you're going to have lower rates, and if, in fact, over the last 2 years, higher rates have restricted growth and caused small cap to underperform large cap by 9% per year for 3 years, big number. And over long periods of time, small cap and the S&P basically are equal to each other. Vols are different, but, you get equal returns. There's really no reason to believe that if interest rates are going to decline, and we're not going to have a recession, and we could, but if we didn't, small caps are going to outperform.
I guess the if is if interest rates are going to decline, because we thought 6, and then maybe 5 cuts, and then, maybe we'll get 3. And now there's people saying, I've had people say we'll get 1 cut. I don't even know why you would cut 1. That makes most sense. But that's assuming that the next move is not an increase if inflation stays bad or even comes back.
Yeah, I think there's no chance for an increase.
And we are restrictive now.
Yes, I think there's no chance for an increase, but the Fed is in definitely a tricky situation. If they cut rates too quickly, then and inflation accelerates, that's a terrible place for them.
Is your whole thesis based on them cutting for small caps?
Yes, I do think that the Fed has to cut at some point. And my thesis is that they're not going to increase rates. My thesis is that they will be slow in cutting rates. I've said that for
why cut at
years.
all? Because you think that there are
because you have an unnaturally high cash rate. You don't need cash rates at this level unless you are attempting to restrict growth. And so there's every reason to believe that they will cut rates and get down to a normal position.
Even with inflation pointing in the wrong direction, I mean, the numbers we got on Friday, the PCE.
Well, the numbers are erratic. They're not, they're not just going up and they're not just going down, and we'll see what the numbers are this week.
3 months, they're going up, and they're revising the last several months even higher.
Some of the revisions have been higher, and look, I'm the first hawk on inflation sticky. And people said inflation is just going to fall like a rock, and it never has, and I didn't think it would. But I do think you've had 2 years of restrictive activity here, and you're going to, you're beginning to see breaks in the broad economy. I had Altice last week, the largest capitalization structure in Europe, was downgraded to CCC, and that's a major company. We're going to see more of that. We've seen banks struggle. We've seen real estate struggle. There are things out there that are obviously impacted by higher rates. And so we need to see consistency in the data, and the Fed said that. And that's not, don't be confused over that. That's what they mean.
Do you worry about stagflation?
No, I'm not worried about stagflation. If I have a worry, it's that we have a recession. That would be my concern.
The move we've seen in the markets, you attribute to what?
Well, again, if you look over time, the markets are not really outperforming by that much. In fact,
they finally caught up after a couple of years.
Yeah, in fact, from end of 21 till today, I think the compound growth rate is like 6% or 7% or even less. I think it's 4%. So it's not like the market is,
But was it the easing, the expected easing? Was it the strength of the economy as far as earnings? What was it sentiment was so negative. It was the most hated bull market in the world last year, the entire year, right?
Yeah.
I don't think you were very bullish for a while.
Yeah, it took me a while to churn, but I think in the last 6 months, the markets look attractive enough to invest in over the long run. And I do think the Fed is going to have to reduce rates. And if you don't have a recession, which we could, but if you don't, then I think the market's cheap.
Do you think that there's some Keynesian benefits going on? I don't know whether, the worry about Keynesian benefits is that they come due at some point down the road and there's no free lunches. But do you think some of it is all the money allocated for chips or infrastructure or EV transition, any of that stuff? Is that all that money sloshing around still?
Well, I definitely think that some part of the fast rise in inflation was a reaction to COVID and the fiscal stimulus that was created.
Is that some of that still around?
And yeah, sure, but it's less than it was, and it's petering out. You see consumers increasing their borrowings. One of the great benefits we got out of very low interest rates is, I don't know what the percentages are, but they're 60 to 70% of homeowners have incredibly low interest rates on mortgages, at 3.2%. And so if you think about the discretionary income that creates at the consumer level, that's significant. And that's still there. That's not going anywhere. And people are in control of that. If they want to sell their homes and pay higher rates, they can. But if they don't, they'll continue to have that discretionary income. So I do think that that's helping this situation. I think that's helping the Fed keep rates higher and slow the economy down. And I do think that may be one of the reasons why there's not a recession.
That's the last thing I was going to ask you about. I forgot.
It adds to the inequality, though. It adds to the inequality. People who are first-time homeowners.
Sure,
people who
absolutely,
are to move.
Absolutely. And that's one of the reasons why, actually, if you get to some stability, you actually see a pickup in housing, because there are a lot of first-time homeowners who haven't been able to buy, and because prices have been elevated. And that, there is pent-up demand. You look at the rental markets. That's part of the reason why inflation doesn't come down that fast.
Right.
Because people have to rent.
When are we going to see some crowding out in terms of if we got every time we do another auction for the $33 trillion, you wonder, how do rates come down? I mean, it'd be nice because the debt service will be, but how do we get people to take the paper with lower yields?
Well, so let's talk about where we are in the yield curve. So now you're talking about further out in the yield curve, not the short paper. So the question is the 10-year at 4.2% fairly priced? And can you really get people to buy all the paper they have to buy at 4% or 3.5%? And personally, I've never thought that. I actually think that the U.S. government's going to have to pay up.
It still happens.
And it's still happening. And I think you've got to get 150 to maybe 200 basis points of real interest, real return.
To go 10 years.
And so if you have a 2%, inflation rate, you're going to have 4 or, at least 3.5. And so I don't think it's any surprise at all where we are in the 10.
So you're talking about short rates coming down. But
short rates will come down.
And long rates could go up then.
Long rates could go up. And you wouldn't be shocked if they did.
No. Because
what if inflation sort of bottoms out at 2.5? And you have a 2% real rate, that's 4.5. And 4.5%, percent 10-year Treasury, that's not even unusual. In fact, a 4% Treasury at 10% rate is more unusual.
Right.